Phase 1. The discovery. The charts move, and suddenly something flickers in your brain. You don't grasp the mechanics yet, but you see the ascent, and a voice in the back of your mind whispers, "That's money." It is 11 p.m. on a Tuesday, and you've stumbled onto a YouTube video where a man posing in front of a Lamborghini discusses pips and spreads. You barely understand half the jargon, yet you are mesmerized. You watch another, then 3 more. By 2 a.m., you've opened a demo account in total secrecy. It feels like a clandestine world you aren't supposed to inhabit yet. The interface is a labyrinth of MetaTrader 4 candles, red and green bars with numbers jumping erratically. But you learn just enough to execute a trade. You hit buy on EUR/USD. The digits climb. $12. You close the position. You've just generated $12 in 4 minutes. The fact that it's virtual currency is irrelevant. The sensation was entirely real. Your palms are warm. You lean back, staring at the glow of the screen and wonder, why isn't everyone doing this? That specific question will eventually cost you a fortune before you truly understand the answer. You spend the following 3 weeks consuming every scrap of information you can find. Moving averages, RSI, support, and resistance levels. On an internet forum, you find a strategy claiming an 87% win rate. You screenshot it, print it out, and treat it as gospel. You deposit $500 of your own hard-earned money. The demo was practice, but this is reality. When you're alone, you finally call yourself a trader. You take your first live trade on a Tuesday morning, buying GBP/USD because you saw the pattern from the screenshot. The market moves against you instantly. You hold on, telling yourself it will return. The video said to be patient. It doesn't return. You lose $80 in 40 minutes and close the trade simply because you can no longer bear to watch the numbers bleed. You sit in silence, convincing yourself you simply chose the wrong currency pair. Phase 2. The grind. You have lost $300 of your initial $500, and you've convinced yourself that more knowledge is the only missing piece. This conviction will keep you trapped in this phase longer than greed or stubbornness ever could. It is the deep-seated belief that a definitive answer exists, that it is learnable, and that someone has recorded the secret on a page you just haven't found yet. You become a glutton for content. Baby Pips, Investopedia, countless books, and a $97 course from a modest YouTuber with clean slides. You start taking meticulous notes. You finally learn the correct way to manage risk, discovering that professionals only risk 1% to 2% per trade. You learn about RR ratios and restructure your life. You draft a formal trading plan in a Google Doc with headers and protocols. You deposit another $300. For 4 days, you are a model of discipline. On the 5th day, however, you spot a setup that isn't in your plan, but it looks textbook. You go in with 5% of your account. In 22 minutes, it's gone. You don't record that trade in your Google Doc. The cycle becomes a hauntingly familiar rhythm. Discipline, then impulse, then loss, then a return to discipline. You assume the flaw is your psychology, having read that trading is 90% mental. You try meditation, journaling, and pre-trade checklists. Sometimes they help, often they don't. The reality you haven't faced yet is that you aren't losing solely because of psychology. You are losing because you are trading patterns that lack a statistical edge. You can be perfectly tranquil while placing a mathematically losing trade. Discipline cannot salvage a broken system, but from your current perspective, you are blind to that fact. You join a Discord server with 4,000 members, where people flaunt green screenshots and upward-pointing arrows. There is a guru who posts a daily bias, and you start following his lead. He's right about 55% of the time, while the market is essentially a coin flip at 50%. You can't tell the difference. 8 months pass. Your account fluctuates wildly, from $300 to $180, back to $600 with more deposits, then down to $310. Net-wise, you're down roughly $800. You tell yourself you're still learning. You are, just not the lessons you think you are. Phase 3, the edge. Around the 10th month, a shift occurs. You stop searching for the Holy Grail, not because you found it, but because you are exhausted. There is a unique fatigue that comes from chasing a horizon that never gets closer. One day, you simply stop running, stand still, and look at the reality in front of you. What you see is price. Just price. Moving, vibrating, forming structures. You begin to observe rather than read. You spend hours watching charts without placing a single order. You aren't hunting for signals. You are studying behavior. You watch where price loses steam, where it accelerates, and whether its reversals are clean or chaotic. You start noticing nuances that were previously invisible because you were too busy looking for confirmation of your own biases. You build a modest framework, 2 or 3 rules, specific sessions, specific pairs, and a hard-coded risk. You backtest it manually through months of historical data. The edge is modest, perhaps a 56% win rate with a 1 to 1.5 risk-to-reward ratio. It isn't glamorous. There are no supercars in this spreadsheet, but it is tangible. During your first month using this framework, you gained 6%. You took 11 trades and followed the rules on 9 of them. The 2 trades where you deviated both resulted in losses. The 9 disciplined trades netted that 6% return. You sit with that realization for a long time. The following month you're up 4%, then down 2%, then up 9%. This is what actual consistency feels like. It isn't what you imagined. It's quieter, more monotonous, and feels a lot more like a job. You quietly leave the Discord server. The noise is no longer useful. You don't need a guru's bias. You have your own. You learn the hardest skill of all, not trading. Your account reaches $1,800. For the first time, you aren't gambling. You're managing expectancy. Phase 4, scaling. After 6 months of consistency, you have weathered losing streaks that made you question everything. You've refined your model and added capital, bringing your total to $5,000. The percentages remain the same, but the dollar amounts have changed. A 6% month is now $300 instead of $18. You feel the weight of the numbers differently. A $200 loss makes your chest tighten, but you don't panic. You know the loss was valid within the model. You refrain from revenge trading. This, you realize, is true growth. You connect with a small, private group of traders who share your level of competence. You share journals instead of signals. You debate the nuances of execution rather than making grandiose predictions. The conversation is honest. People admit mistakes without it becoming a crisis. You realize that everything you consumed in your first year, the flexing and the $5,000 days, was just a product designed for level 1 customers. You don't feel bitter, you just see it for what it is. By month 18, you are managing $12,000 and return 7%, over $800 made from your apartment. You wait for it to collapse, but the system holds. You start viewing a 6-figure account as a technical problem to be solved rather than a fantasy. Phase 5, the professional. You are now managing $80,000. Some of it is yours. Some belongs to partners who tracked your performance for months. You have clear terms, profit splits, and drawdown limits. Your life has been re-engineered around the market. You've stopped drinking because you've empirically proven. It degrades your decision-making. You sleep 8 hours because your data shows a direct correlation between rest and trade quality. You don't discuss trading at social gatherings anymore. Most people lack the context to understand it, and you've grown tired of explaining that it isn't gambling. At this level, you're making enough to live on, but you remain cautious. You keep 3 months of living expenses in cash, separate from the market. You endure a difficult April where you hit an 8% drawdown. You have to walk your capital partners through every decision. They stay, but the weight of accountability is heavy. Your system is now leaner and more refined. You can go 3 days without a setup and feel no urge to click. You've mastered the art of waiting. Phase 6, the operator. You manage $400,000, built through reputation and introductions. You have operational systems in place, reporting templates, compliance folders, and a drawdown protocol. You even have a part-time assistant for the administrative burden. By lunch, you are managing massive positions, and strangely, the money no longer feels real. The numbers dissociated once you pass the $150,000 mark. Now they are just units of risk and exposure. Your life is structured, like an office job, but the market never truly lets you go. A news event on a Saturday still commands your attention. Your friends have stopped asking about your work. They know you trade, but they don't really know. Your only peer is a friend who trades for a fund. In that conversation, you feel normal. Everywhere else, you are translating your life into a language others can understand. You aren't unhappy, but you are acutely aware of what this career costs. Phase 7, the architect. Your operation has grown to a team of 7, including analysts, a risk manager, and a developer. You manage $4.2 million. You are no longer the one clicking the buttons. You are the architect of the system. Your risk manager executes the protocols you designed. Stepping back was an agonizing process of letting go of the wheel, but it was necessary. Your investors are now family offices and high net worth individuals who care about sharp ratios and drawdown duration. You are running a business that generates alpha. Sometimes late at night, you pull up a chart just to watch the price move, not to analyze it, but to remember the raw possibility you felt at the beginning. Then, you close the laptop and go home. Phase 8, the apex. It is 3 p.m. on a Wednesday and your office is quiet. You manage $22 million, a number that has become infrastructure rather than a trophy. It is the capital that sustains salaries, technology, and compliance. You possess a deep, intuitive understanding of markets that you can't fully explain to others. You've seen every pattern fail in every possible way. You understand that the market isn't a puzzle to be solved, but a vast, living crowd. Your edge is simply knowing where the crowd is wrong more often than you are. Your investors trust you to do the worrying for them, a foundation that sits beneath everything you do. You eat lunch alone, preferring the silence. You've thought about what's next, scaling further or stepping away. But for now, you just watch the city from your window. You're in the elevator when a message arrives from your operations manager. A new junior analyst asked a question about a pattern, a question full of misplaced confidence and incorrect assumptions. You remember asking that same question years ago. You type back a thoughtful response, letting him find the answer himself. Somewhere, right now, a beginner has just posted a screenshot of a $340 demo profit, claiming they've figured it out. The fire emojis are already pouring in. They'll deposit their first $500 this week. They think it's simple. They are wrong. But they'll stay, just like you did. They always do.